Good morning, my name's James Gerrish, the primary contributor at Market Matters, and I'm joined today for another Market Matters video update by Peter O'Connor, a very well regarded resource analyst here at Shaw & Partners. And thanks for joining us again, Peter. I'm here to get your views around the resource stocks in general, the resource sector. It's obviously been a hot sector in the last little while. We're going to focus today on areas that, there's been some capital management initiatives being rolled out for the big guys. I want to touch broadly on that. Yield in the resource area of the market. Resources are around headwinds and tailwinds. So there's some areas of the market that have headwinds, some have tailwinds. And then I want to focus just at the end briefly on gold and get your key picks on gold. So, from the bigger picture things, what are the main narratives around the resource space at the moment? BHP Rio obviously in focus.
It's good to be here, James, as usual, and it's been a really volatile couple of months. So the narrative is kind of still there, but there's a few tweaks as well. So look, the key backdrop has been global growth, and that global growth narrative, which has been a fantastic backdrop from January 16, kind of petered out around the middle of this year in June when the tariffs started to kick in. So the last 3 months has more been about the headwinds, which I'll come back to, about tariffs, and that noise around that, and how big will they be, what impact, and how do we price that into equities.
What's your gut feeling of how this plays out in terms of Trump tariffs? Is it posturing ahead of midterm elections, or is there something more bigger at play here?
Look, firstly, the tariffs are unequivocally negative, okay? It's just a function of how negative they may be. And taking that a step further, Trump's a negotiator. Trump sets amber claims. Trump then comes back and negotiates a middle ground. We're starting to see that with the Mexican deal, the Canadian deal, and what they call the NAFTA 2.0 deal. The Chinese thing is taking longer than I thought, but it's more about posturing. There's the midterms coming up 1 month away. So there's a lot to play with here. So it's about negotiation, it's about finding a middle ground. So given the pullback we've had, and just to go back to that perspective of the cycle, we had 5, nearly 6 bull markets during the last 3 years. We've had 1 bear market pullback. Feels like it's pretty much priced in the tariff outlook. So
a higher low in resources.
That's what it looks like, yeah, for sure. But within that, and what I want to touch on, your thoughts there, the sector financially looks the best ever. And I don't use that word lightly. So again, the best ever. So the balance sheet, we have 80% of the companies in the sector with net cash. Now, if you went back to any other period of time, it would have been 80% with net debt, and the few that had very low net cash would have been the big guys. It's the other way around. So the 5 or 6 companies that have net debt, they've all got a pathway to retire debt. BHP, Rio, Newcrest, Fortescue, they can retire if they choose, but it's the smaller end, which has traditionally been geared, has got net cash, and a lot of net cash, and building net cash. So first point being, balance sheet's best ever. Secondly, free cash flow yield is extraordinary. So we're seeing free cash flow yield this year at about 9%, next year at about 11%. If you look at the underlying dividend to see how much cash they're paying out today, it's about 3.1%, which is historically getting quite high. So what I like to think about is, what is the surplus out there? Look at the free cash, take off the dividend, what's left to play with? It's about 6% this year and about 8% next year. To give you dollars, what that means to you and I, that's about 13 billion Aussie dollars to play with for the next 12 months, and about 17 billion Aussie dollars the next 12 months. So combined, about $30 billion, which could find its way back to shareholders.
So there's what we've seen in Rio, and what we're likely to see with BHP is obviously more buybacks, more capital management coming through. But is there, typically when commodity prices are high, it influences new production to come online. We're not seeing that as much this time. We're seeing more miners return capital to shareholders. So
it's funny, with growth is not so much the narrative within the mining companies at the moment, it's about returns. And that's partly because shareholders have been wanting that. So we're starting to see dividends lift with earnings, dividends lift with payout ratios, which is reflecting the cycle. We're also starting to see some special dividends paid, or top up dividends. And we're seeing more buybacks. So you've talked about BHP and Rio either starting or about to. BlueScope, South32 are running programs at the moment. And importantly, the numbers I just gave about the cash available, that excludes the asset sale cash. So there's a whole portfolio management part to this as well. So that $30 billion, when you add the Rio and BHP assets, that's about $50 billion. So shareholders will start to get the benefit of that over the next 1 month, 2 months, 12 months. So dividends and income will be a big part of the sector for quite some time. That's quite a change to that headwind of tariffs. It's quite a good bottom-up story.
On the commodity side of things, are there obvious areas that have got tailwinds from a commodity perspective, an underlying commodity perspective, and areas that have got headwinds? Is iron ore neutral at the stage? is that got headwinds given the supply coming on stream? You know, how does the nickel market look, the copper market, for instance?
It's a good question because it's been, I wouldn't say it's been easy, but it's been quite a good backdrop for the last 3 years because we've had tailwind and almost everything's gone up without question. So now it's getting harder. We've got to be really picky about where we look. So specifically, there's some great tailwinds in commodities. They're very patchy, and we've got to be very careful about how much momentum is involved in those. One standout, which has just happened in the last 2 or 3 days, is the alumina market, which is influencing 2 of our equities, Alumina and also South32. That will come and that will go, but it looks like there's another 3-month window where that price for the commodity could stay quite high, and therefore the equity as well. So that's a standout tailwind. But looking at the commodities as a whole, there's the ones that are starting to look stretched, which need further momentum to sustain, are what I call the Rust Belt. Coal, manganese, steel, they're starting to look a little bit stretched. They've got momentum for now, given there's some supply issues in each, but they're the ones I look at and I go, I just got to watch those really closely because they will roll over quite quickly. The area that's been looking quite cheap or favourably priced is the energy side. So energy is a complex, be it oil, gas, LNG, even uranium. They look extraordinarily cheap relative to long-term views of value and relative to their peers. The base metals are looking about fair value to slightly cheap, and the precious metals, given their pullback of late, have come way back into the realm of they look really cheap again.
Yeah, that brings me on to gold. So, you know, gold is obviously, you can buy gold for a whole host of reasons. It's probably been weak because of the strength in the US dollar over the last little while. In the last week or so in particular, we've seen US interest rates, bond yields really spike higher. We've got wage growth over in the US. That's likely to lead to inflation down the track. Is gold something we should be looking at in terms of allocating to that area?
We should. It's starting to look, and there's 3 reasons I'd say as well to yours. At the moment, it suggests that it is the place to be. Gold looks cheap, and the key parameter for that is, and I saw an interesting anecdote the other day, the Dow Jones index divided by the gold price, as simple as that sounds, is a really good indicator of the relative value of our equity versus gold. And what it's highlighting is gold today, physical gold, as cheap as it has been in 20 years, going back to the tech bubble. Okay, so 2 quite distinct.
And arguably, we've got more risks now than that we have in recent times. And that's the second point.
So risk is building again, whether it's Italy, just late, it's North Korea, or it's China, or it's NAFTA. There's risk out there, and it's building ahead of the midterms, etc. So that's another part. And the third part, which is more tactical, but positioning within options, has been extremely negative, both in gold and in copper and other commodities. That's starting to unwind.
And in individual gold stocks.
Correct.
Newcrest positioning, I've noticed, has been really dominated on the put side.
Those 3 factors are telling me that the timing is right. It is late cycle, inflation is building, as you mentioned, and it's likely to build as a Fed move. So the timing's, it's feeling right. So that window opportunity in gold is looking interesting. And the equities, broadly speaking, globally, have been massive underperformers. So there's an opportunity.
Key picks.
Evolution Australia is a key pick. It's Northern Star would be. It's the most written up stock. It's doing nothing wrong. It's an outstanding story. It just doesn't look cheap. It's the most expensive gold stock globally right now. They're delivered and they will continue to deliver, but it just doesn't look cheap. So I'm happy to hold it, but I'm not happy to buy it. Evolution's had a pullback post their results for the financial year 18. They delivered a record year last year. For 19, they guided slightly lower, and the market didn't like that. But I think what's key there is a recent analyst day and investor day, as well as a site visit, talked about how much tail that company has got. They've got a regulatory approval which came through this morning, which starts to go to that point. And you'll see upgrades coming through for the value of Evolution, and I think you'll find that will take the stock higher. So Evolution is my key pick given its recent pullback, and it's large, liquid enough, and it's starting to get some index effect from offshore as well. And at the big cap end, Newcrest stands out for the reasons you mentioned, as well as the fact the recent Barrick Rand Gold deal just highlighted how much people will pay for resource.
And how much
Newcrest
has got on the ground.
30 years reserve, 30 years resource on top of that. They're one of the biggest tails in the market. Somebody will look at that at some point. If
so a takeover of Newcrest.
It has always been a takeover. It always will be. I don't know what the trigger will be, but as a minimum, the market will look at it and go, wow, that resource looks cheap. It's just too cheap, so I'll bid the stock up. So whether it's a target or whether it just gets fair value on the back of that, I think Newcrest is looking extraordinarily cheap. They've had some operating issues. They look largely addressed. They've got an analyst day coming up at the end of the month and a site visit as well to that site, so we should address most of those issues.
So that could be the catalyst for Newcrest at the back end of this month.
Evolution's had the catalyst, the news is just creeping through, but I think Newcrest is going to come through in a couple of weeks, so I'd be happy with either or.
In terms of catalysts, so BHP, we've got the AGM over in London, I believe, middle of this month, and then middle of next month in Australia. So that'll be the catalyst around their capital.
The proceeds from the big asset sale will come through, like I say, late October. So If they get those, they'll then make a decision about how to deploy that. It's likely they'll wait to the AGM in Australia, which is on 8 November, so maybe a week or two after that the proceeds come in the door. At that point, they'll announce the deployment, which is likely to include a very large off-market buyback in Australia, like Rea is doing now. Discounted 14%, it'll be heavily oversubscribed, so
large
big
cap,
scale
yeah,
back,
large
cap.
yeah.
It'll have an extremely dominant driver on the market over that period of time, which will be November, December for BHP. So you get a squeeze in the stock price, and that'll get it towards our target price of $40, as well as the oil price backdrop, which I only just touched on lightly. But oil looks to be the best commodity, and BHP enjoys about 25% of its earnings from oil, so they come pretty substantial upgrades as well.
Thanks for joining us today,
Thank you, James.
Peter, and we'll talk again soon. Bye for now.